It's August 2026, and the Federal Reserve has parked its benchmark interest rate at 3.5 to 3.75%. Following a series of cuts late last year, policymakers have now maintained this exact range for 5 consecutive meetings. Normally, 5 months of high borrowing costs act like gravity on the economy, pulling down growth and cooling inflation. But current data is sending conflicting signals that have effectively locked the market in place. GDP growth is slowing down, yet home values are pushing higher. Top-line inflation is dropping, but prominent Federal Reserve officials are actively campaigning for further rate hikes. Traditional economic indicators are currently fighting each other. The resolution of these 3 contradictions will define the roadmap for the next major market shift. Looking at the growth data, the first estimate for second quarter GDP showed an annualized rate of 1.5. A decline in government spending and a surge in imports pulled that figure well below the 2.1% pace recorded in the first quarter. That slowdown was partially offset by a single sector: intense business investment in AI data center construction. This chart from the Bureau of Economic Analysis tracks personal consumption expenditures. The top graph shows headline inflation fell to 3.7% in June. However, the bottom graph shows core inflation is stickier, easing only slightly to 3.3%, keeping the overall trend above the Fed's 2% target. That persistent core inflation led Federal Reserve Presidents Beth Hammack, Lori Logan, and Neil Kashkari to vote against the hold. They argued for a quarter-point hike, citing fears that Middle East tensions could spike energy prices and reignite inflation. Policymakers are trapped. They cannot lower rates to rescue a slowing GDP because global geopolitical instability could instantly restart the inflationary cycle. The second paradox centers on housing. High federal funds rates directly increase mortgage costs, which should theoretically crush demand and lower prices. Instead, home values are accelerating. The Case-Shiller Home Price Index shows a 0.6% jump in home prices between April and May. Even when adjusting for normal seasonal patterns, home values are still 1.1% higher than they were this time last year. In real-world terms, a $500,000 home appreciating at 4% adds $20,000 in equity to the owner's net worth in a single year. This creates a powerful wealth effect for existing homeowners, while building a massive financial barrier for first-time buyers. The final paradox involves a labor market reporting both record low layoffs and high long-term unemployment. Initial jobless claims recently edged up to 197,000, which is an incredibly low level that suggests companies are refusing to fire their existing staff. But continuing claims remain elevated at 1.782 million, meaning workers who are currently unemployed are taking much longer to find their next role. A shift toward unrecorded gig economy work is likely masking some job losses, while traditional companies have effectively frozen their hiring pipelines. The workforce has become entirely stagnant, effectively trapping both the employed and the unemployed in their current positions. The current rate hold reflects a state of paralysis caused by these 3 conflicting signals. Cutting rates could overheat the housing market and reignite inflation, while raising rates could break the fragile, stagnant labor pool. Employment data serves as the catalyst that will eventually force the Fed to move. This week features several critical releases: JOLTS job openings on Tuesday, private sector payrolls on Wednesday, and the non-farm payrolls report on Friday. Market participants are waiting for these specific releases before making their next move. While you watch the data come in, you can celebrate National Peach Month with a peach and blueberry crumble.